The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and a warm welcome to all. I'm Mridul on behalf of Care Ratings. Welcome you to our today's webinar on assessing India's investment climate. I appreciate your time in joining us for this webinar. Speakers for today is Ms. Kavita, Chacko, Senior Economist at Care Ratings. Along with her is Dr. Rucha, Ranadive, Economist. The discussion is in form of a presentation which is visible on your screen. In case of queries, we'll be having a Q&A session as soon as the presentation ends. May I request Kavita to begin the session?
A very good afternoon to all. We thank you for joining us in this webinar today. Investments are critical for growth in the economy. It drives demand for products and services and is necessary for job creation. The slowdown in domestic investment across segments in recent years has been a factor weighing on economic growth. Disruptions on the demand and supply side in recent years have impacted fresh investments. A question that is posed often is whether there has been any revival in the investment cycle in the economy. It thus becomes necessary to analyze if there has been an improvement in investment activity this year. There are different indicators that can be used to gauge investment intentions and fructification of the same. In our webinar today, we are examining various indicators that give an indication of the pace of investment activity and thereby help one form an opinion on whether there has been a recovery in investment activity. Some of the macro indicators that we would be looking at here would be gross fixed capital formation or investment rate, capacity utilization, industrial entrepreneurs memorandum, industrial output, investment in projects, funding of investments, and the capital expenditure being incurred by the government. We also look at the geography-wise and industry-wise investment scenario to see which are the regions and segments that have been driving investments in the country. Based on the estimates by the Central Statistical Office, there are signs that gross fixed capital formation or investment rate for the Indian economy is improving this year. The gross fixed capital formation as a percentage of GDP, which has witnessed a continuous decline since financial year 2012, has seen a marginal pickup in the first 9 months of the ongoing fiscal year. The investment rate at 29% of GDP has grown by 0.3% from year ago, but continues to be significantly lower than the investment rate of 34.2% in FY 2011-12. The investment rate does not indicate if this is due to private or public investment. However, other indicators suggest that the government could be the driving factor for the overall investment in the country. The capacity utilization rate, which indicates the extent to which a firm's production capacity is being utilized, has shown signs of stability in FY19 so far. There was a notable improvement or turnaround in capacity utilization in the last two quarters of FY18, which was largely on account of destocking in the first 2 quarters of the fiscal due to the implementation of GST. The order book, inventories, and capacity utilization survey by the RBI shows that the average capacity utilization rate for the first half of FY19 at 74.3% is a continuation of the improvement seen in the second half of FY18 when the capacity utilization rate rose to 74.6% from 71.5% in the first half of that fiscal. Despite the improvement, the utilized capacity of firms is significantly lower than the utilization rate of 83.2% in Q1 2011. The capacity utilization rate has seen a sustained decline since then. Typically, a capacity utilization rate of 78 to 80% in an industry would be a trigger for fresh investment. The present upward tendency is a good sign as it does indicate that there would be fresh investments in specific industries where the rates are higher. It can also be seen as being a lead indication of a revival in investment activity. Industrial output growth is another indicator of whether or not there is a momentum in investment activity. Growth in industrial output, as measured by the Index of Industrial Production for the first 10 months of FY19 at 4.4%, has been higher than the 4.1% growth a year ago. The IIP growth numbers for the investment related categories too shows an improvement. The year-on-year growth in output of capital goods at 6% and infrastructure goods at 8.4% in the first 10 months of FY19 has been the highest since FY15. This is indicative of higher investment activity. Industrial Entrepreneurs Memorandum data, which is captured by shows an in sorry the IEMs filed show a positive picture for this year. For the calendar year 2018, there has been an increase in the number of IEMs filed. It was 16% more than in 2017. While these refer to only intentions, it is still positive from the point of view of reflecting potential investment. IEMs implemented in 2018 at rupees 2.5 lakh crores were the highest in the last 3 years. 56% of the IEMs were implemented in 2018 versus 20% during 2014 to 17. The CMI data on capital investments too indicates an improvement in investments this fiscal from the previous year, albeit a marginal increase. The volume of new investment projects announced has increased and the number of projects stalled or abandoned declined. The volume of new investments in the first 9 months of the ongoing financial year at rupees 7.4 lakh crores was rupees 40,000 crores more than year ago, while the stalled investments declined by rupees 20,000 crores to 4 lakh crores this year from year ago. This is a positive as projects dropped can have a bearing for the financial system in terms of servicing of borrowings. Projects completed were higher this year as seen from the decline in outstanding investments. It need be noted here that these projects would have been undertaken over the years. The various channels of funding available to businesses helps indicate the investment intentions. Here bank credit offtake, borrowings from corporate bond markets and external commercial borrowings are looked at. The bank credit growth this year has been higher. Incremental bank credit offtake this year, that is between April to Jan, has grown by 10.5% vis-à-vis 6% growth of last year. Although growth in bank credit continues to be driven by the services sector and personal loans, there has been an improvement in credit growth by the industrial sector too. Credit growth to industry has grown by 1.9% in FY19, an improvement from the negative growth of last year. Within industries, credit growth has been driven by large industries, while small industries continue to see a contraction in credit growth. 10 out of 23 key industries registered positive credit growth during the year. The bank credit offtake in the industry was driven by glass and glasswares with growth of over 17%, while chemicals and infrastructure grew by more than 10%. At the same time, petroleum and coal, basic metals, gems and jewelry, beverages, tobacco and textile are some of the industries that have seen negative growth in bank credit in the current financial year. Corporate bond issuances this year have been lower. As per data from Prime database, corporate bond issuances during April to February 19 is rupees 5 lakh crores compared with rupees 5.5 lakh crores of last year. Industries such as real estate, power, roads and highways, telecom, pharma and transport accounted for 22% of the total corporate bond issuances this year. Borrowings through external commercial borrowings or the ECB route are normally directed at investments. ECB registrations during April to Jan 19 were at US dollar 26 billion, which is 42% higher than the $18 billion ECBs of FY 18. Greater flexibility provided by the RBI, combined with pressures on the domestic banking system, made this a viable and attractive source for companies. Investments in the country are currently being driven by the government. The central government has spent more money as capital expenditure in FY 19 as per the revised numbers made available compared with FY 18. It was rupees 3.2 lakh crores in FY 18 and is estimated to increase to rupees 4.1 lakh crores in FY 19. State budgets data reveals that for FY 19, they have jointly budgeted capex of rupees 5.38 lakh crores compared with rupees 4.71 lakh crores in FY 18. Investments in public enterprises too have witnessed a noteworthy increase since FY 18. On a year-on-year basis, investments in public enterprises grew by 74% in FY 18 and by an additional 12% in FY 19. The government's higher capex should get reflected in other variables, however with a lags. A part of the higher performance of capital goods segment in the IIP can be attributed to higher government expenditure. Now I request Rucha to take you through the geography-wise and industry-wise investment scenario.
Thank you, Kavita. We shall now assess the investment classification in terms of ownership, industry, and state. It has been observed that over the years, the government has been increasingly driving the investment in the economy. Private sector share in outstanding investments is on the decline. It has fallen by 5% since FY 15. However, in terms of new investment, private sector investment is seen to be on the rise. Chart on the left hand side suggests that in terms of outstanding investment, the government has a dominant share of more than 50% in the last few years. Government share increased from 51% in FY 15 to 56% in the current fiscal. It needs to be noted here that the government investment also includes investments by the public sector enterprises. With respect to new investments, as shown in the chart on the right hand side, the private sector participation has seen to increase over the years. The share of private sector in new investments has increased from 44% in FY 15 to 68% during the 9 months of FY 19, amounting to rupees 5 lakh crore. In terms of sectoral composition of new investment, there has not been a notable change over the years. Services continue to have a dominant share, followed by manufacturing and electricity. The share of services and manufacturing has increased while that of electricity has declined over the years. When compared with FY 15, the share of services has declined from 46% to 41% during the first 9 months of FY 19, while that of manufacturing has risen from 19% in FY 15 to 33% in FY 19. In terms of annual growth rates, the new investments in the services sector have seen declining in past 2 years. In the current fiscal, the new investments amounting to rupees 3 lakh crore contracted by 9% compared with a year ago. The main contributors for the sector are transport services with 33% share, followed by wholesale and retail trade, and IT, both of which have a share of around 2%. New investments in the manufacturing sector amounted to rupees 2.4 lakh crore this year. There has been an improvement in the new investment in the manufacturing sector in the current fiscal from the negative growth in the preceding 2 years. New investments have grown by 28% this financial year. Within the sector, it is chemicals and metals which have been driving the overall growth. The state-wise bifurcation of the outstanding investment reveals that the top 7 states accounted for nearly 50% of the outstanding investment. These states included Maharashtra, Andhra Pradesh, Gujarat, Odisha, Karnataka, Tamil Nadu, and Uttar Pradesh. Among the states, Maharashtra continues to account for the largest share in the outstanding investments. Its share has risen from 9% in FY15 to 12% in the current fiscal, with investment totaling rupees 22 lakh crore. Similarly, Andhra Pradesh and Uttar Pradesh too have seen an improvement in investments. It currently accounts for nearly 8% and 5% respectively of the outstanding investments in the country. Andhra Pradesh has seen an improvement by over 4%, while in case of Uttar Pradesh, it has been only a marginal improvement. On the other hand, the share of Gujarat, Odisha, Tamil Nadu, and Karnataka have seen a moderation in their share in the outstanding investment. In terms of new investments, 7 states, namely Maharashtra, Andhra Pradesh, Haryana, Odisha, Gujarat, Uttar Pradesh, and Tamil Nadu, accounted for nearly 55% of the total. While the share of Maharashtra and Odisha improved over the past 5 years, that of Andhra Pradesh, Haryana, Gujarat, and Tamil Nadu declined marginally. Maharashtra, which had a mere 3% share in the total new investments in FY15, has seen a substantial improvement in its share, surpassing all other states. It now accounts for 24% of all new investment in the country. In the 9-month period of FY19, the new investment in Maharashtra totaled rupees 1.7 lakh crore, which was more than double from 0.8 lakh crores during the comparable period in FY18. Maharashtra was followed by Andhra Pradesh with 9% share and Haryana with 6% share, both of which saw a dip in the share over the years. However, in terms of growth, new investments in Andhra Pradesh grew by 97%, whereas in Haryana it improved by 3.8% in 9-month FY19 compared with the corresponding period last year. Gujarat also witnessed an increase in new investments by 57%, with the new investments aggregating to approximately rupees 32,000 crore. To conclude, there are signs of investment intentions being positive, albeit to a limited extent. Industrial production numbers indicate that there has been a revival, and the gross fixed capital formation reveals marginal improvement. Higher growth in bank credit and ECB registration too are a positive sign. Juxtaposing this with the improved capacity utilization rates, it is possible to say that the future looks positive in the absence of any shock or disruption. The government has been a driver of investment and would need to continue being so to stimulate private investments. Private investment would trail public investment and be driven by factors such as capacity utilization, bank lending, NPA resolution, interest rate, among other factors. Thank you.
Thank you, Rucha, Kavita. The participant will be taking a break of 2 minutes before we begin our Q&A session. If in case of any queries, you are please requested to key in the questions. I repeat, we'll be having a break of 2 minutes before we begin our Q&A session. Thank you.
Welcome back. We have a few questions here. One of the questions is, where will the funding for increased investments come from? This would be a mixture of bank credit, equities, bond market, and ECBs. There is another question. Do you foresee any pickup in private investment in coming years? Yes, we do foresee a pickup in private investments. However, we feel that it should be a gradual pickup, which will be contingent on improvements in demand conditions, increase in capacity utilization rates, ease of funding, and the interest rate scenario, among other factors. We have another question. Will the industrial output be affected on account of the upcoming general elections? Uh, uh, we do not foresee any disruptions to industrial activity on account of the forthcoming elections. We have another question. Are investments in consumer goods an important segment in overall investments? Uh, Consumer goods have a very small share in overall investments. They account for around 1% of new investments. We have one question. What is the investment outlook for Q1 and Q2 FY20 given the upcoming elections? Uh, we we feel that the improvements which we have seen since the second half of FY18 are likely to be carried forward in FY20 also. We feel that there would be a pickup in investments, although it would be a gradual pickup in private investments, and it would continue to be driven by and overall investments would continue to be driven by the government investments.
I think there are no more queries coming in, and probably that was the last question taken up for the day. Thank you for being a part of this Care Ratings webinar. In case of any feedback, suggestions, you're please welcome to write to us in the suggestion box, which will be coming no sooner the webinar end in your email box. Thank you and goodbye for now.